Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now after the bank soiree, Michael Mayo as well. Mike, let me dovetail in technology into banking. You and I remember E.F. Hutton. They didn't keep up on technology. A.G. Edwards, they didn't keep up on technology, and on and on. Which bank is leading in using potential AI and in using present technology?
Well, that's an easy first question, Tom. JP Morgan is the NVIDIA of banking. They're leading with AI. They have it centralized. They say that most of their employees use it every day to save a bit more productivity. They seem strategically and operationally ahead of the pack. They do spend a lot of money on technology. They spent $18 billion this year on technology, and the amount to AI continues to increase. So they think it's real. Right. They're embracing it, and it's it starts more non-customer facing activities, but they're certainly ahead of the game.
Right. Mike Mayo with us, folks. Howard Lutnick moving from 8:15 to 8:45. Okay. Secretary of Commerce here in half an hour. Paul Sweeney.
Hey, Mike, when we came into this second Trump administration, one of the sectors that was really called out as a potential beneficiary was the financial services industry, primarily from a perspective of maybe loosening of some of the restrictions on the big banks. What have we seen? What have we learned so far?
Well, yesterday was the first ever Federal Reserve conference to overhaul regulation, specifically capital rules. And I had the pleasure to present on one of the panels. So I was back in Washington, D.C. at the Federal Reserve Board for the first time in 33 years.
Wow.
And I would say this was remarkable. This was at their headquarters building. In the front row was Chairman Powell and Vice Chairman Bowman, taking notes all day on 5 different panels. By the way, Sam Altman was the keynote speaker, and they're operating with eyes wide open to modernize bank regulation, to keep up with the times, update some stale parts of it, and to create a more level playing field with more transparency and a more holistic approach. What
are some of the big items, Mike, that you think may be ripe for change?
Well, I think the capital rules. I mean, this is really, there's an alphabet soup of acronyms. They overlap. It double counts. It's convoluted. So I think they can make it, less complex, less convoluted. In my opening slide yesterday, I said, thank you, regulators, for a great job you did after the global financial crisis, but the rules are too confusing, too constraining, and too costly. And so to the extent that you can make them, less complex, that's important. To the extent that you can make them less constraining, I mean, banks have been marginalized. I mean, as a percentage of total corporate loans, banks have gone from 60% down to 40%. Loan growth for the last 2 years, adjusted for inflation, has been negative. And you see a lot of the loans go to the shadow banking industry. So those are some of the changes.
Mike Mayo with us here with Wells Fargo. We continue with Mr. Mayo. We welcome all of you on your commute across the nation, at home, in the office, our new distribution, YouTube. Thank you so much for subscribing to Bloomberg Podcast. Paul?
So, Mike, give us a sense of timing here. I know that, the Jamie Dimons of the world would like these rules kind of relaxed yesterday. Realistically, what's the timing here?
Well, this year is about updating the stress test. You saw that last month in terms of a little bit more clarity, a little bit more less harsh, I'd say. And the assumptions are already more harsh than the actual experience during the global financial crisis. We're not talking about going back to 2007 or those sorts of days. So that's this year, I think. Next year, there's international capital rules. That's likely to get modified. And then by the year after that, I think you should start seeing efficiency benefits. And this can be win-win-win. The regulators can win because it should cost less money for the oversight. The banks can win for more profitability, but the customers can win because that profitability, a bit of that's going to be passed on to them, and they'll have more options.
Mike Mayo, on the banking front, you look at your major overweight view, M&T up in Buffalo, maybe a bit of a caution there. Finally, you get a hockey stick move in Citigroup, a really, really nice move, even after the 10-to-1 reverse split of decades ago. Reaffirm your strong buy on Citigroup.
Well, Tom, as you know, I've been on your show a few times since last year. It was slow going, through parts of last year, the tariff sell-off, but Citigroup remains my dominant number one pick by a mile.
Why?
And I think, well, look, what's underappreciated, they've transitioned from 50 years of a global matrix mismatch structure to 5 lines of business: payments, banking, markets, consumer, and wealth. And each one of those lines of business, has a P&L, they have returns, they have targeted returns, and they have a CEO that's in charge of achieving those targeted returns. Now you say Jane Fraser, the CEO, does not get a Nobel Prize for doing that, but Citi is now getting operated more like a normal company, and they're only 6 quarters into this new structure. Short term, people are selling the stock inappropriately due to the tariffs. Citi is a tariff beneficiary. They move $5 trillion of money every day around the world. Now, it might be moving to different countries. Also, a lot of customers around the world need trade financing. They need more trade financing now. Foreign exchange. So this really fits right into Citi's structural positioning while they make the structural change.
Perceive it on price to book using the BQ screen on the Bloomberg. I've got JP Morgan 2.44 price to book. Citigroup's really recovered from a Deutsche Bank disaster, if you will, folks, out to 0.9. So Citigroup's at 0.9. JP Morgan's at 2.44. Mike, in your head, how much of that delta can Citigroup make up?
Well, they can look. Which of my kids do I love more? And those are the 2 stocks that have been on our firm's signature pick list. So JP Morgan's best in class, Citi's worst in class. So I do think though that Citi can re-rate and trading below book value when it's not a crisis, when they're making these sort of moves, is a little unusual. So I think the stock has 50% upside over the next 2.5 years to $150. And there's no analytical gymnastics with doing that. That's simply as Citi's returns go up from 7% last year, and that's return on tangible equity, to 10 to 11% next year, and then higher after that, mathematically, you get higher stock prices. So it's there's line of sight for the restructuring. And Tom, you know what's unique for any industry? Any industry, when you say there's a restructuring, okay, what's going to happen to revenues? Citi's revenues were up 8% year over year in the second quarter. So here with Citi, you have a unique story of a restructuring with revenue growth. And that's unique for any company.
Paul, get one more in here with Mr. Manning. He's got to go work out.
Exactly.
Are you doing upper body or lower body today, Mike?
This is a lower body day. Thanks for asking.
Good.
And I'm doing my deadlifts and squats, and I'm still trying to, push forward.
Well, Michael Barr and I are as well. Paul, get one more in here.
Exactly. Hey, Mike, what did you take away from the big banks' earnings last week?
This is an inflection. This is an on-ramp to double-digit EPS growth after having negative year-over-year EPS growth for much of the last year and a half. And we see this double-digit EPS growth for the next 10 quarters through the end of 2027. So, and after that, we'll see.
Mike Mayo, thank you so much with Wells Fargo there in Citigroup, and also on the technology over 270 Park Avenue.